Everyone wants to live a stress-free financial life, but how do we get there? In No Worries 2024, money expert Jared Dillian offers strategies for achieving financial freedom. Giving up your daily coffee isn't going to solve all your money issues, and it may make you miserable. Instead, you need to focus on major financial decisions. Debt and risk are the main causes of financial stress, but they can be overcome. Dillian promotes an abundance mentality over a scarcity mindset, focusing on revenue growth. He offers a guide to buying houses and cars, using credit cards and student loans, and creating a stress-minimizing portfolio. Mindset matters. Most people struggle with financial worries. The true culprits behind this financial stress are debt and risk. If we can manage them effectively, we can build a life where money is not a perpetual source of concern. Some individuals willingly accept lower earnings because they derive satisfaction from their work. This is a legitimate economic choice. Jared Dillian traded a high-pressure Wall Street job for a more fulfilling career in writing, despite an initial decrease in income. However, it's perfectly acceptable to aspire for more money and material possessions. Such desires are natural and should not be suppressed. Getting a raise and taking a second job are two common approaches to making more money. To secure a raise, it's often more important to be in the good graces of your boss, as raises are frequently awarded to favored employees rather than the most industrious ones. While working multiple jobs or engaging in a side hustle can be invigorating and enjoyable, this approach does not address the issue of scalability, which is vital for significantly boosting income. Changing careers to earn more money is a formidable challenge, as it involves reshaping your identity. If you are making a major career switch, you must conduct thorough research and invest the necessary effort to facilitate the transition. Investing in education, such as business school, can pave the way to higher earnings, but it's imperative to assess whether the cost will be offset by the anticipated income. Passive income, such as rents from being a landlord, is often perceived as effortless money, yet it demands active management and entails risk. Establishing passive income streams requires dedication and hard work. Launching a business can be rewarding and potentially lead to wealth accumulation, but it is also fraught with risk and difficulty. Dillian's newsletter business has evolved into a multi-million-dollar operation. Scalable businesses like a newsletter can expand rapidly with minimal overhead costs. Ultimately, increasing your income requires altering your self-perception and committing to substantial hard work. The right mindset is a critical factor. Prioritizing happiness. Wealth is derived from a handful of significant decisions rather than numerous minor ones. Eschewing small daily indulgences like coffee will not resolve financial issues. It is the major decisions that have a substantial impact. Some millionaires practice frugality throughout their lives, foregoing small pleasures and accumulating substantial wealth, but failing to utilize it. They neither enjoy life nor assist others. Preparing pizza at home to save money is illogical if it consumes 3 hours and your time is valuable. Allow Domino's to handle the pizza while you engage in more productive or enjoyable activities. There are 3 pivotal financial decisions that you need to get right. They are purchasing a house, buying a car, and managing student loans. Opting for less expensive alternatives in these domains can lead to considerable savings and a more contented life. A modest house or a less costly car will not render you miserable, but they will save you a significant sum of money. Debt is a primary source of financial stress. The absence of debt is liberating. Prioritizing debt repayment is essential to alleviate stress and enhance net worth. While it may be challenging to completely avoid debt, the aim should be to minimize and eradicate it as swiftly as possible. Concentrate on the major financial decisions and do not fret over minor expenses. This approach fosters financial success and happiness without necessitating extreme frugality. Coming from a Wall Street background, Dillian's perspective on debt often perplexes colleagues. They question the rationale behind paying down a mortgage at 4% interest when you could potentially earn 8% from the stock market with the same money. However, stock market returns are unpredictable. Many investors earn less than the market average due to poor timing and emotional decision-making. Paying down a mortgage can alleviate stress, and investing in real estate can be as advantageous as investing in stocks. It is important to balance debt reduction with investing in retirement accounts to capitalize on compounding returns. Investing can be exhilarating. This prompts many people to engage in trading on platforms like Robinhood. But paying off a mortgage, though less thrilling, brings tranquility and reduces stress. Financial risk is a second major source of stress. Stocks, representing partial ownership in a company, generally appreciate over time, but can also experience significant declines. Market volatility induces emotional turmoil, leading to imprudent investing. Prioritize risk management over returns. Volatility often results in panic selling during market downturns. Financial stress stems from debt and risk, not from a lack of money. Happiness, not wealth, is the ultimate objective. Those who enjoy risk should gamble with a small portion of their money and keep their savings in less volatile investments. Enhance your revenue. The key to financial contentment is to enhance income. Many people overlook the potential to increase their earnings. Corporations concentrate on revenue growth, and individuals should adopt a similar approach. Take risks to augment income, such as asking for raises or changing careers. People frequently remain stagnant in their financial lives due to a fear of failure. However, taking action can lead to prosperity. A scarcity mentality is predicated on the belief that resources are finite, akin to a pie that requires careful division. However, this perspective is flawed because wealth is not static. It can be generated. For instance, when a company is valued at $90 billion, that wealth was not extracted from others. It was created by the founders and employees who built something of value over time. Rather than partitioning what exists into smaller segments, it is more advantageous to concentrate on creating more, which epitomizes an abundance mentality. Achieving this mindset leads to financial liberation. Decisions about expenditures, such as paying for a meal without agonizing over the budget, become devoid of stress. This freedom is not attained through excessive frugality. It is crucial to strike a balance in your financial habits without being either wasteful or overly cautious. Steering clear of high-interest loans and credit card debt is prudent. Individuals with wealth lead easier lives because they are not burdened with the constant stress of financial survival. This freedom facilitates generosity and happiness. The potential for unlimited earnings or upside is critical. Government jobs offer security but limited financial growth. In contrast, jobs as real estate agents or tech entrepreneurs present significant upside potential. Seek opportunities with upside, such as owning company equity or stocks. Even participating in the lottery within budget can be a form of entertainment with the potential for a substantial windfall. Ultimately, becoming a billionaire is not solely a matter of luck. It also requires hard work and the ability to preserve wealth. The key to financial success is to concentrate on revenue and pursue upside, but remain receptive to luck. A balanced financial life. Material possessions contribute to happiness, despite adages to the contrary. It is natural to desire things. The FIRE movement, which stands for financial independence, retire early, advocates living frugally for 10-15 years, saving $1 million, and retiring early to live simply. This philosophy is flawed because simplicity is not suitable for everyone. As individuals earn more, they tend to spend more, and this is a natural part of life. The key is to strike a balance with money, saving some, spending some, and not allowing it to dominate your thoughts or emotions. Save and invest early in life, then spend and savor wealth later on. Many people never transition from saving to spending, missing out on the pleasures their money can provide. It is important to have a healthy respect for the future and not be immobilized by fear. Spending money can affirm your self-worth, but ensure the math is sound before making substantial purchases. Charitable giving is another facet of a balanced financial life. While Americans do contribute to charity, the amounts are often modest. Try donating less during your early asset accumulating years and more later on. This strategy allows for more impactful contributions over time. Dillian has observed both frugal millionaires who shop for clothes at discount stores and high rollers who lose everything. Both extremes can be detrimental. A balanced approach to money, including a prudent respect for debt, is optimal. It is essential to manage debt judiciously and be prepared for economic downturns. Recessions are a natural component of economic cycles, and while they can pose challenges, they also present opportunities for those with capital and courage. A balanced approach entails saving sufficiently to endure difficult times and being prepared to invest when prices are low. Money and relationships. Our personal life influences our relationship with money. Childhood financial trauma is an example. It's common for children to react against their parents' financial behaviors. As an adult, selecting the right life partner is the most critical financial decision you can make. It is imperative to marry someone with compatible financial values. If a frugal individual marries a spendthrift, it is likely to lead to disaster. Money issues are a frequent cause of divorce. Maintaining separate finances helps prevent financial disagreements. Dillian and his partner opted to keep their finances separate, which meant no arguments over purchases. They divided common expenses like rent and utilities proportionally based on income. When they purchased a house, they tracked their contributions and owned different percentages of the property. This system may appear complex, but it has kept their marriage free from monetary conflicts for more than 2 decades. Both partners should be financially literate and informed about all accounts. Avoid lending money to family or friends. It often leads to damaged relationships, especially if the borrower fails to repay. Instead, you should make gifts with no expectation of repayment to prevent resentment. Investing in a family member's business should be based on its merit, not the familial connection. Early-stage investments can be profitable, but should constitute a small portion of your net worth due to the high risk of failure. Parents have varying approaches to teaching their children about money, from providing allowances to paying for chores. Parents should cover most college expenses. Prestigious institutions offer significant advantages. When purchasing a car for a teenager, the teen should share in the burden in a small proportion. Teenagers require early job experience to acquire essential skills, such as showing up on time, not just task-specific ones. Understanding money. Before delving into the stress associated with debt, it is essential to comprehend the nature of money. In a rudimentary economy, direct bartering is inefficient, particularly if one party is not interested in the other's offerings. Money resolved this dilemma by serving as a universal medium of exchange, a unit for valuing goods and services, and a means to store value for future use. Banks are secure repositories for money, although the interest they offer fluctuates over time. Whatever the interest rates, keeping money in a bank remains safe. Many individuals lack proficiency in investing, often earning below the market average or incurring losses. For some, simply depositing cash in a bank is a more prudent choice. Having cash on hand is crucial for emergencies. It's a financial safety net for unforeseen events, such as job loss or medical emergencies. Cash also provides the flexibility to capitalize on opportunities, whether for investment purposes or personal desires. A substantial cash reserve enables prompt action without the need to liquidate other assets. Try to maintain 20% of your net worth in cash. Some cash should be kept as physical currency for emergencies when electronic transactions may not be feasible. Using cash can also aid in managing spending and ensuring privacy. It is reasonable to keep a portion of emergency funds in cash at home, as withdrawing larger amounts from banks may require planning. Banks are the go-to place to keep cash since they're safe and insured, but they may offer little to no interest. Certificates of deposit and high-yield savings accounts can earn some interest, but it may not be much. CDs require locking up money for a certain period, and there's a penalty for early withdrawal. Treasury Direct is a lesser-known option where you can buy us treasury bills and bonds directly from the website. T-bills, which are securities with less than a year maturity, are popular for their short maturity. In 2022, they offered yields of 5% or more, which was better than banks. I-bonds, which are inflation-linked, are also available on Treasury Direct, but purchases are capped at $10,000. Gold is a controversial investment with political implications. Owning gold can signal distrust in the government's economic management. Some people become gold bugs, heavily investing and following gold-related conspiracy theories. However, gold does have a place in investment. Physical gold has high transaction costs for small investors, but there are easier ways to invest in gold, like gold exchange-traded funds ETFs. For example, the GLDF, launched with Dillian's help, allows investment in gold without the hassle of physical ownership. Credit wisdom. Credit cards can cause stress, but they're not inherently evil. They're convenient and necessary for building credit and making large purchases. However, they can lead to financial stress if not used responsibly. To control credit card debt, you need to budget and cut expenses if necessary. It may not be a credit card problem, but a spending problem. Keeping track of daily expenses and avoiding unnecessary purchases can help maintain a low balance. Dillian prefers using credit cards for the points and pays off the balance monthly. Many people are fixated on collecting credit card points, but often they don't use them. Credit card companies cleverly promote cards based on points rather than low interest rates. Points are essentially cost-free marketing. Dillian uses points for free flights or an occasional hotel room, but points can lead to spending more overall, like on rental cars and meals during trips. When it comes to the value of points, it's usually a small saving, around 1–2% of purchases. Cashback cards are generally better, as they reduce the temptation to spend more. Credit card interest rates are high, around 20%, partly due to the costs of running a credit card company. Credit card loans are also risky for banks because they're unsecured, unlike mortgages or car loans. If someone defaults on a credit card debt, the bank has little recourse. If borrowing is necessary, a personal loan with lower interest is a better option than carrying a credit card balance. Credit scores assess borrowing habits rather than income. Paying bills on time and not using all your available credit will help you maintain a good score. High debt utilization can significantly lower a credit score, even if all payments are made on time. It's important to monitor accounts and not rely on companies to look out for your interests. Try to pay off the balance every month to avoid the negative compounding interest of revolving debt, which can grow exponentially. Checking credit card balances weekly can help manage spending and avoid debt accumulation. Debit cards can also lead to costly overdraft fees. Home buying truths. Most home buyers get pre-qualified for a mortgage to determine the maximum loan they can handle. The lender figures this out so that the mortgage payment, insurance, and property taxes will equal about 42% of income. However, you shouldn't spend more than 25% of your income on housing. In expensive areas, this can be challenging. Buying a house that's too big is a common mistake. A smaller house won't make life miserable. It's manageable and allows for financial freedom in other areas. Sacrificing small luxuries like coffee is harder than foregoing a large house. In the US, a child's education quality is linked to their neighborhood, pushing housing prices up in good school districts. It's important to recognize the economic trade-off of living in a desirable school district. Buying a house is a huge financial decision, and it should be approached with an understanding of the risks involved. Houses are not investments like stocks or bonds. They cost money in maintenance, taxes, and insurance and can depreciate over time. While housing prices generally increase, they can also decrease, as seen during the 2008 financial crisis. Most people don't pay for houses in cash. They make a down payment and borrow the rest. This makes buying a house risky. If the house's value decreases, you could lose your investment or owe more than the house is worth. Mortgages are loans secured by property, and they're relatively safe for banks because they can sell the house if payments aren't made. Government-sponsored enterprises like Fannie Mae and Freddie Mac help keep interest rates low by securitizing mortgages, which are then sold globally. FHA and VA loans are for low-income borrowers and veterans, respectively. They offer low or no down payments, but they make it hard to build equity and can trap homeowners. These loans are securitized and backed by the government, potentially costing taxpayers if defaults occur. Jumbo loans are for more expensive houses and may have different terms. Putting down more than the minimum is beneficial for building equity and reducing payments. The 30-year fixed-rate mortgage has helped many people build wealth through mortgage payments. However, most people don't live in a house for 30 years, so shorter-duration mortgages like the 15-year mortgage might be more suitable. Refinancing a mortgage means getting a new loan at a lower interest rate to replace the old one. It requires a new appraisal and paperwork because it's essentially a new loan. Buying an affordable house is crucial. Only buy a house if you can afford it. Education. Student loans are a significant issue. The government doesn't check credit for these loans, which are unsecured and often have high balances due to income-based repayment plans. These plans result in payments too small to cover the interest, causing loan balances to grow. Student loans can't be discharged in bankruptcy, trapping some in debt they can't repay. To escape student loan debt, earning more money is necessary. Graduating with excessive debt can delay life milestones like marriage and homeownership. For top-tier schools like Harvard, paying whatever it costs is justified due to the name recognition and networking opportunities. For second-tier schools, which are small private liberal arts colleges, it's advisable not to accumulate more than $40,000 in debt. Student loans should be paid off within 5 years to avoid long-term financial strain. For a third-tier school, which is everything else, only attend if it's affordable without loans. Graduates from these schools often struggle to pay off debt with limited earning potential. Law school is even riskier due to the oversupply of lawyers, which has reduced their income significantly. Top law schools may still offer good prospects, but lower-tier schools can leave graduates with high debt and low income. Medical school debt is usually manageable, except for those in family practice. Doctors and dentists still earn well, though they're increasingly becoming employees rather than owners. Some people argue for free higher education, but this approach has failed in places like Argentina, where it has led to a decline in the quality of education. Not everyone needs college. Trades can be lucrative. Many students don't fully engage in college, wasting the investment as they focus on social life. Graduate school can be different, with more mature students excelling in their chosen fields. For those burdened by student loans, aim for increasing income rather than cutting expenses. With a graduate degree, you can pivot to higher-paying roles. Buying a car. Car buying can be a negative experience due to sales tactics. Car dealerships make money on financing and services, not the cars themselves. It's better to pay cash and be wary of long-term loans and dealership practices. With cars being so costly, financing is often necessary. Car loans work like mortgages. It's crucial to buy what's affordable and consider paying off the principal early to shorten the loan. Loan terms are stretching out as cars get more expensive, but longer loans mean more interest paid. Stick to a 5-year loan. If the car is too expensive for that, find a cheaper one. If possible, pay cash for a car. Cars are pricier than before, largely due to safety and emissions rules. Take backup cameras, for instance. They add $800 to each car, costing us billions annually. If people had a choice, many would prefer a simple, affordable vehicle over a high-tech one. Before visiting a dealership, research the value of the car you're trading in and the one you're buying. If the numbers don't add up, ask questions. Don't be intimidated by salespeople. Be ready to walk away if necessary. Negotiate firmly, and don't get emotionally attached to a car. Car salespeople, often unregulated, can be aggressive and manipulative. Be informed and cautious, especially with high-interest loans at fleabag dealerships. Buying used cars can save money, but this can backfire with maintenance costs. Cars depreciate, so it's unwise to borrow heavily for them. Keep transportation costs below 10% of income. Leasing seems cheaper monthly, but it's costly long-term since you don't own the car. Uber aims to use cars more efficiently, but its affordability decreased after it went public. Still, considering all car ownership costs, using Uber might make sense financially. Reliable cars like Toyotas and Hondas are better investments. They last long and retain value. Avoid expensive trucks that are more status symbols than practical. Navigating risks. Investing can yield better returns than a bank account. Mutual funds are pools of money invested in stocks for participants. If stocks rise, investors profit. If stocks fall, they lose. It's important to consider the likelihood and extent of potential losses when investing. Stocks are volatile, with a nearly 50% chance of losing money daily and a 26% chance annually. The average stock market gain is about 9% per year, but this comes with risk and stress. Risk often correlates with returns. High-risk investments like tech stocks can be lucrative but stressful. It's crucial to find a comfortable risk level. Emotional control is key in risk management. Adopt the mantra, "This too shall pass," for both losses and gains. Less frequent portfolio checks can lead to better decision-making. Diversification is the best defense against market unpredictability. It involves owning various assets to balance performance. However, diversification can lead to average returns, and some investors aim higher. Concentrated portfolios can yield high returns, but carry significant risk. Mutual funds offer diversification, but individual stock trading often lacks it. Finance can be a fun hobby, but thinking you're a legendary investor is when trouble starts. Very few can trade for a living. Most people don't have the emotional control required. Stick to your day job and play with investments on the side. There's no magic solution to investing. The markets are always changing. The aim is to create a resilient portfolio that can withstand market cycles. Diversification minimizes financial stress. Don't put all your money into one stock. Aiming for a steady 8% annual return can lead to a comfortable retirement. Insurance is essential to minimize financial stress. Wall Street knows to insure against catastrophic losses to avoid financial ruin. This applies to health, auto, and life insurance too. Surprisingly, many people don't insure their investment portfolios, which can be done, though it's costly. Diversification is a form of insurance for your investments. Being an optimist in investing can be profitable, but it's important to be cautious. Markets have historically recovered, but there's no guarantee. The thrill of trading may not be worth the stress. Some people are natural risk takers, but not everyone is cut out for it, and that's okay. Understanding the business cycle is important for personal financial planning. Knowing key economic indicators like unemployment rates and GDP can help gauge the economy's health. It's wise to be financially prepared and not rely on government assistance during tough times. Stocks, dividends, and bonds. Owning a stock means having a stake in a company. With even a single share, you're entitled to vote on company decisions, though investors with millions of shares wield more influence. Companies that offer shares to the public must adhere to regulations set by the Securities and Exchange Commission and disclose their financial statements. There are around 3,000 public companies in the U.S. Private companies aren't obligated to share their financial information. Stocks are traded on exchanges. There are about 17 exchanges in the U.S., many of which are electronic. The U.S. has complex yet efficient markets, so there's little concern about being cheated on trades. Purchasing stocks is typically based on the expectation that a company's earnings will grow, leading to an increase in the stock price. However, this isn't always the case. Some companies with rising earnings don't see their stock prices climb significantly, while others that aren't profitable can see their stock prices skyrocket. Stocks that capture the imagination of investors often perform the best, regardless of whether those dreams are realized. Dividends are a portion of a company's profits distributed to shareholders. Investing in stocks with growing dividends and reinvesting those dividends is a potent strategy for accumulating wealth over time. Trading stocks should be a pastime, not a primary wealth-building strategy. For serious investing, mutual funds or ETFs are the better choice, with mutual funds being preferable for long-term investment. Mutual funds don't trade on exchanges and are priced once per day, which helps investors resist the urge to trade frequently. Bonds are essentially loans that are traded in the capital markets. They're an important component of diversification and can offer more stability than stocks. Currencies and commodities are also tradable, but they're generally not recommended for the average person due to their complexity and risk. The most sensible approach is to create a simple, diversified portfolio of mutual funds and ETFs, contribute regularly, and allow it to grow over time. This method minimizes stress and effort while providing a good chance for a comfortable future. The financial industry often employs the 60-40th portfolio model, which is 60% stocks and 40% bonds. This traditional strategy is based on the assumption that when stocks decline, bonds rise and vice versa, balancing out the risk. However, this doesn't always hold true. For example, in 2022, both stocks and bonds underperformed. Hard assets. Stocks and bonds are both financial assets tied to future cash flows. There are other types of assets, such as hard assets, which include land, real estate, and commodities. These can also be good investments, especially real estate, including purchasing a home. Real estate can offer protection against inflation and often appreciates in value when inflation rises. Commodities such as oil, corn, wheat, soybeans, and cocoa are a form of hard asset, but they're not as commonly invested in by individuals. Investing in commodities involves costs, such as storage fees, which can diminish the value of the investment over time. Commodities typically don't appreciate in value over the long term due to technological advancements that make production more efficient, leading to lower prices. Owning commodities is essentially betting against human progress, which isn't a sound strategy. The awesome portfolio. A well-rounded portfolio should include a mix of financial and hard assets. An ideal portfolio would have equal parts stocks, bonds, cash, gold, and real estate. This is what Dillian calls the awesome portfolio. It's straightforward, with each asset class representing 20%. The awesome portfolio has demonstrated an 8.1% annual return since 1971, with less volatility than a stock-heavy portfolio. Even during the worst financial crises, it has proven to be resilient. The awesome portfolio should be your primary investment strategy, with perhaps a small portion allocated for speculative investments. Annual rebalancing of the portfolio is essential to maintain 20% allocation across asset classes. It's important not to get overly creative with the portfolio, as attempts to outsmart the market often result in poor outcomes. The awesome portfolio is designed to have a low correlation between its components, meaning they don't all move in the same direction at the same time. This reduces overall volatility and helps investors avoid making impulsive decisions during market fluctuations. The goal is to have a stress-free financial life, and the awesome portfolio offers solid returns with minimal risk. Based on financial habits, there are two types of people: those who are extremely frugal and high rollers. Extremely frugal people might choose the cheapest menu item, haggle over every price, and live well below their means even if they're wealthy. They obsess over saving every penny, which can lead to a life lacking enjoyment. High rollers, on the other hand, spend excessively, often racking up debt and living on the financial edge. They might have closets full of unworn clothes, multiple subscriptions they don't use, and no savings or retirement funds. Both types believe they're making smart choices about money, but they're actually driven by their deep-seated beliefs about scarcity or abundance. Neither extreme is healthy. A balanced approach to money means not obsessing over it, and allows occasional splurges that bring joy without incurring debt. On the investment side, a balanced approach means taking some risk, but not so much that it's a constant source of stress. Similarly, debt should be used to achieve goals without overextending. The right amount of spending and risk is subjective, but it generally means not being consumed by thoughts of money. It's about living within your means, not being stingy or showy, and enjoying life's pleasures without financial stress. Ultimately, the goal is to reach a point where money is a tool, not a source of worry. Achieving financial independence, owning a home, and having savings brings peace and the power to live on your own terms.